The stock market and the economy are facing a paradigm shift. What does it mean and how do we adjust going forward? Find out on this week's Video Market Update. So think of all of the things that are happening right now that we haven't had happen for decades. We've had the first major global pandemic in 100 years. The first invasion in Europe in over 75 years. And in the US, the first major bout of consistent inflation in 40 years. All of these together are making for a paradigm shift in the way that the market and the economy is reacting and evolving. We're seeing it in a couple of different metrics. One, we're seeing it in the price of oil that continues to go through the roof, which is resulting in higher gas prices. As we have higher gas prices, there tends to be less consumption of it, which doesn't necessarily drive the price down because enough people are consuming it where you're not really seeing a price reduction at the pump. You're also seeing retail sales have gone down drastically. And a lot of major retailers like Walmart and Target are having to readjust from expecting people to go back to business as normal when the pandemic waned and businesses opened to people focusing really on just the basics, just the staples. So last week, JP Morgan CEO Jamie Dimon said that there is a financial hurricane approaching. If you read the context, he said it could be a category 1 or it could be a superstorm Sandy. Now, that's pretty scary language. Now, Brian Moynihan, the CEO of Bank of America, came out and somewhat refuted that and said he thinks that the US consumer is in a good place, which actually puts pressure on the Fed as they're looking at raising rates, because as consumers are doing well, the idea if we could raise rates, does that slow economic growth and then hurt the consumer? The president of Goldman Sachs kind of echoed Jamie Dimon's comments about a financial hurricane, but this headline that just came out from Goldman Sachs says the US economy will slow in a crawl as the Fed hikes rates, but will dodge a recession. So if there's this shift from fairly massive growth, and we're seeing, and you can see here, that stocks are down anywhere between 9 and 23%. We're seeing a cool in the market. We're also seeing a bit of the market's kind of taking a big breath and almost, and trying to see where we go with this paradigm shift. But a couple things that we do know, that there are still some fundamentals that have performed well. We know that consumer staples are doing well because there are things people have to buy even when the economy seems to be slowing down. So the question is, as we have this shift from wild growth, wild speculation on companies, we are going to settle back down into more of the staples. And that is why staying the course and having a diversified portfolio helps, because if you're overweighted in a sector, that sector may be part of the paradigm shift. If you're balanced equally, while you may feel it in a part of the portfolio, there's going to be another part of the portfolio that's going to be up, right? Because as one sector goes down, tendency is another sector will rise. So the best way to prepare for this shift is to be balanced, to be diversified, to have a level of cash on hand that you're comfortable with. I think we're going to see stability, and that could be stability meaning we know the market's going to start creeping up, or stability that the market's going to start creeping down over the next 2 Federal Open Market Committee meetings where the Federal Reserve is going to give their outlook on inflation. One's coming up June 15th and 16th, and then one in July. So as we see this shift, what it tells us is we still have to go back to the old fundamentals of asset allocation and diversification. If you have any questions on this and anything we talked about in this video, let me know. If not, I hope you make it a great week.